So welcome ladies and gents, my name is Peter Yusuf. I'm the Senior Market Analyst of IronFX, and together we'll be going through a webinar about the week ahead in the FX markets. Before we start though, a small risk warning. Always bear in mind that our products are traded on margin, carry a high level of risk, and it's possible to lose all your capital, and these products may not be suitable for everyone, and you should ensure that you understand the risks involved. Also, a disclaimer: the information in this webinar should not be considered as an investment advice or investment recommendation, but instead as educational material only. This material is just the personal opinion of the author, and clients' investment objective and risks tolerance have not been considered. IronFX is therefore not responsible for any loss arising from any information herein contained, and please note that redistribution of this material is strictly prohibited. With no time to waste, now the war in Ukraine is ongoing, creating mayhem in the markets, fueling oil's prices to levels not seen for more than 10 years. We expect the issue to remain one of the main, if not the main, fundamental issue among traders in the coming week as well. On the monetary front, we would highlight the interest rate decision of ECB on Thursday, which more or less may find itself in a difficult spot right now, while policymakers from other central banks around the world may also sway the market mood in the coming days. As for financial releases, we expect a lighter calendar, yet there are still a number of high-impact financial data to be released that could shake the markets. We note on Monday the release of China's trade data for February, and on Tuesday the release of Eurozone's revised GDP rate for Q4 2021. On Wednesday we get the revised GDP rate of Japan for Q4 2021, and on Thursday we get the US CPI rates for February. On Friday we highlight UK's GDP and manufacturing output growth rates for January, as well as Canada's employment data for February. Moving now to the US dollar, and this would be the USD Index H4 chart. Now, the USD has been in an upswing, and it's currently testing practically the 98 resistance line. It's just above it, thus turning it into a support line for now. We tend to maintain a bullish outlook for the dollar, given also the upward trend line guiding it for the past 48 hours plus. Also note the RSI indicator below the 4-hour chart, which is at the reading of 70, which on the one hand tends to underscore the dominance of the bulls. On the other hand, though, may imply that the index is nearing overbought levels and may correct lower. To the downside, we definitely note the 98 support line, the 97.40, which used to be practically a resistance line back here and provided some support here, and lower than that would be the 96.75. To the upside, we note the 98.80, the 99.45, and the 100 resistance lines. Now the USD continued to be on the rise for a fifth consecutive week. Yet we must note that the US employment report for February is still to be released later today in the American session, and under certain circumstances may alter the direction of the US dollar. Moving now to US dollar's fundamentals. Overall, the war in Ukraine seems to worry not only traders but the general public in the US. It was characteristic that President Biden in his State of the Union speech on Tuesday showed the US solidarity to Ukraine and even got personal against Russian President Putin. Overall, the speech demonstrated the decisiveness of the US to confront, not directly but still, Russia. Note that he stated clearly that the US will not engage in conflict with Russian forces in Ukraine. Now, despite the speech being dominated by the war in Ukraine, the president also vowed to curb inflationary pressures back home by a master plan including cutting the price of prescription drugs, reducing energy costs for families and others, while also stated that his plan to fight inflation will lower your costs and lower your deficit, unquote. Now, the same worries about inflation also tended to dominate Fed Chairman Jerome Powell's testimony before the US Congress on Wednesday and Thursday. The Fed Chairman stated that inflation increase sharply in the last year and is currently running well above the bank's longer run objective of 2%. The Fed chairman in his statement mentioned that it would be appropriate to hike rates, yet avoided any hints towards a 50 basis points rate hike in March, nor did he commit to any particular rate hike path, allowing for some flexibility. As for financial releases, we highlight the release of the US CPI rates for February on Thursday. You can see the relevant chart practically on your screens right now. You can see that the headline CPI rate on a year-on-year level is accelerating as the blue line is rising, reaching levels between 7 and 8%. While on the other hand, the yellow line on a month-on-month basis, the headline rate still continues to feed inflationary pressures on a monthly level. Now the release, along with the accelerating core PCE index, February's employment report, which is due out today, could have a substantial bearing on Fed's interest rate decision. It was characteristic that Fed Board Governor Waller stated that, quote, if, for example, tomorrow's PCE inflation report for January and jobs and CPI rates for February indicate that the economy is still running exceedingly hot, a strong case can be made for a 50 basis point hike in March. That was stated practically last Friday during the Asian session. That's a week-old statement, but still it highlights the importance of the releases to come. We would also like to note the release of the weekly initial jobless claims figure on Thursday, while on Friday we get the preliminary University of Michigan consumer sentiment. That's for March. Moving now to the pound, and this would be cables for our chart. Note that cable has dropped on a weekly level and practically seems to be maintaining a sideways motion, but we see the case for bearish tendencies to continue, given also that the RSI indicator below the 4-hour chart is between the readings of 50 and 30, implying that the bears may have an advantage. To the downside, we note the 1.3275, which reversed the downward motion twice here. Lower than that would be the 1.3170, and the lowest level noted for the bears would be the 1.3065. To the upside, we note the 1.3365, which provided support twice, and has now turned into resistance level as the price action is below it. Higher than that would be the 1.35. Please note that there may not be another support level, resistance level here. And the highest level noted would be the 1.3635, which practically resisted upward pressure of the pair once, twice, 3, 4 times. So it's a rather important level to keep an eye out. Moving now to the fundamentals for the pound. On the fundamental side, the UK government seems to be experiencing a rally around the flag effect at a milder form, as the rhetoric seems to be shifting increasingly towards the support of Ukraine after the Russian invasion. The situation may allow for the UK PM Johnson to slip out of the difficult spot he was in about Partygate in the previous weeks. Nevertheless, the UK Prime Minister also made clear that UK will not be fighting the Russians in Ukraine, as he stated that, I want to be crystal clear, finally on that point, we will not fight Russian forces in Ukraine, unquote. Also, UK PM Johnson highlighted the possibility of an energy price shock after the announcement of the most recent sanctions against Russia. On a more positive note, BOE has said that exposures of banks to Russia are relatively low, which lowers the overall risk factor for the UK economy from the Ukrainian crisis. It should be noted that besides the jump in gas and electricity bills, also fuel prices have gone up in the UK. Overall, the inflationary pressures in the UK economy are still high, and we may see the BOE taking a more hawkish stance to confront the issue. Definitely the market's expectations are hawkish, and it's characteristic that the market seems to be currently pricing in fully a rate hike in its March meeting, while another 2 are partially priced in at the moment according to GBP/ORS. As for financial releases, for pound traders, we note on Monday the release of the Halifax house prices for February, while on Friday we highlight the release of the GDP rates for January, as well as the manufacturing output growth rates for the same month. You can see the relevant chart right now. In the red line we see the manufacturing output growth rate, which declined in the December release. Note how also the blue line, which represents the GDP rate on a month-to-month level, also declined, and may have even declined slightly steeper. So it's an issue, as practically the GDP rate entered the negative territory, even slightly, in December. And we're keen to see whether the new GDP rates, that's for January, will be implying that the UK economy has hit growth levels once again and it's going to be jumping back up again. Should the GDP rate as well as the manufacturing output rate continue to decline deep into the negatives, we may see the pound retreating further. Moving now to the Japanese yen, and this would be USD JPYs for our chart. Now there seems to be a sideways motion here. Nevertheless, we want to note that there has been a slight decline since yesterday's American session, practically breaking below the 115.45. We must note that JPY seems to be losing ground as the US dollar seems to be more able to attract more safe haven inflows. On the other hand, JPY's gains against the common currency and the sterling should not be left out in a technical analysis because they are for a second week in a row. Nevertheless, against the US dollar, JPY, we note to the upside the 115.45 resistance line as the first level. We can see also a second resistance line being forming right here. Higher than that would be the 116.30, which reversed the upward motion of the pair. That was around the 10th of February. And higher than that it would be the 117.50. To the downside, definitely we note the 114.45 providing support. Tested here. And some resistance here. Lower than that would be the 113.70, which was actually tested substantially around the 24th of January, and lower than that would be the 112.65. Moving now to JPY's fundamentals, we note that Japan seems to be hardening its determination against Russia, yet the whole situation may have a hidden cost for Japan, namely the Kuril Islands in the north, which Japan was claiming from Russia. At the same time, recent calls within Japan from former Prime Minister Shinzo Abe towards the Japanese government to consider hosting US nuclear weapons seem to have created tensions with China, yet definitely could create frictions also with Russia given Mr. Abe's influence. Also, it should be noted that Japan joined other Western powers by imposing sanctions on Russia and limiting the transactions with it, according to Japan's Prime Minister Kishida, as Japan would stand by the side of Ukraine. On the pandemic front, we must note that Japan will ease its border controls further, yet seems about to extend COVID restrictions in some areas. On the monetary front, we note that BOJ's approach and its ultra-loose monetary policy seems to remain untouched. On the other hand, we must note that the Japanese government announced nominees to replace 2 central bank policymakers, which are to leave the bank in the summer, and the appointments may tilt the balance of power in the BOJ towards a less dovish approach, according to Reuters, yet that is still a long way off. Now, despite our base scenario being for JPY to continue to be affected primarily by safe haven flows in the coming week due to the war in Ukraine and JPY's dual nature, nevertheless, we would still like to note a couple of financial releases in the coming week. On Tuesday's Asian session, we get the current account balance for January, while on Wednesday we get the revised GDP rate for Q4 2021. On Thursday, we get Japan's corporate goods prices for February. You can see the relative chart in your screens right now. And practically, finally, on Friday, we get from Japan the all household spending growth rate for January. Moving now to the common currency, and this would be Euro USDs for our chart in a clear downward movement as the pair actually tested the 1.10 support line during today's European session. We maintain a bearish outlook for the pair as long as it remains below the downward trend line noted. Note also how the 100 moving average is diverging to the downside from the 200 moving average. Also note how the price action is practically flirting with the lower Bollinger Band. Also an indication of a bearish outlook. Also note that the RSI indicator below the 4-hour chart is at the reading of 30, implying definitely a dominance of the bears, but on the other hand may also imply that the pair is nearing oversold levels and may correct higher. Should the bears actually maintain their dominance over the pair's direction, we would expect the pair to break the 1.10, start aiming for the 1.0935, and even lower we note the 1.0870 to the upside. Should the bulls actually take over, we would expect the pair to break the 1.1055, which provided support the past days and has now been turned into a resistance line given that the price action is lower, break the pre-mentioned downward trend line, and that would be a clear sign, or the first sign at least, that the trend is about to change. Continue higher, aim for the 1.1120, which provided resistance here and support here, and start aiming for the 1.1180. Moving now to Euro's fundamentals. Now the war in Ukraine fundamentally weighs on the common currency, given that sanctions on Russia seem to be biting back as they create substantial uncertainty for the growth of the area's economy. The rise of oil and natural gas prices, along with the expected rise in the price of grain and the number of raw materials that used to be imported by Russia and Ukraine, is a big issue, as is a possible disruption of supply chains. In addition to all of that, the EU will have to face the uncertainty created at its southeastern borders, along with the humanitarian crisis that is expected to follow. Also, please note that a particular worry for Euro traders could be the exposure of European banks to the Russian economy. Banks in a number of countries, such as France's Société Générale and Italy, and have a substantial exposure in Russia. And we would also like to note Austria's Raiffeisen as a possible risk factor. The main event though of Euro traders next week though is expected on the monetary front as we get ECB's interest rate decision. The bank is widely expected to remain on hold, keeping the refinancing rate at 0% and the deposit rate at minus 0.50, with Euro OIS implying currently that there is a probability of 92% for such a scenario to materialize. The main attention of the market participants, though, is expected to be placed on the forward guidance of the bank. It should be noted that inflationary pressures in the area are accelerating, at least according to Eurozone's preliminary HICP rates for February, and is calling on the ECB to act and tighten its loose monetary policy. On the other hand, given the war in Ukraine, the European economy may need all the help it can get on the monetary level. Our base scenario remains that the bank's balance of power would tilt in keeping favorable financing conditions in the Eurozone and maintain its loose monetary policy approach. Thus, we may expect the bank to sound dovish in its accompanying statement, and ECB President Christine Lagarde's following press conference, which could weigh on the euro currency somewhat. Any voices for a tightening of the bank's monetary policy that were heard in the past few months may be silenced for now, and a possible dovish tone could weaken the euro, as we have mentioned. As for financial releases, the calendar is rather light for euro traders. Nevertheless, we would like to note the release of Germany's industrial orders growth rate. That's for January, Monday, and you can see it on the blue line on your chart on your screen. Note the substantial rise in November, aiming for the 4% level, and the subsequent correction lower. On the other hand, on Tuesday we get Germany's industrial output, which is the brown line here. And note how it descended lower below, near but still below the zero, and even lower in December. So practically we have a deceleration here in the growth rate of the industrial output for the largest economy of the Eurozone. On Tuesday, we also highlight the release of Eurozone's revised GDP rate for quarter 4 2021, while on Friday we get Germany's final HICP rate for February. Moving now to the Aussie, and this would be AUD USD's 4-hour chart, a beautiful upward trend line guiding the pair, which is currently testing the 0.7370, at least in today's European session. Also note that we maintain a bullish outlook for the pair as long as it remains above the upward trend line, which is marked in our chart. And the price action is actually running along, if it hasn't even slightly broken the upper Bollinger Band, which could be implying that the pair is nearing overbought levels. A similar statement could be made also for the RSI indicator, which has slightly surpassed the reading of 70. On the one hand, once again showing the domination of the bulls. Yet on the other hand, may imply that the pair is reaching overbought levels and may be ripe for a correction lower. So that should not come as a surprise for traders. Nevertheless, should the upward momentum continue and the buying interest be maintained, we may see the pair breaking above the 0.7370 and start aiming for the 0.7430, with our highest level being the 0.7480. To the downside, we definitely note the 0.7315. Lower than that would be the 0.7275, which provided resistance once, twice, and has now been turned into support line as the price action is above it. And lower than that would be the 0.7230, providing resistance once, twice, but also the pair was aiming for it back around the first days of March. Moving now to the Aussie's fundamentals. Now the crisis in Ukraine, in conjunction with a gradual recovery of economic activity in the manufacturing sector at a global level, have supported the price of raw materials as shortages were created and thus supported the Aussie. As reported by Reuters, prices of coal, one of the main products exported by Australia, rose between 25 and 50% as buyers were trying to replace supplies from Russia. Also, iron ore prices as well as LNG and aluminium prices were on the rise, supporting Australia's international trading activities, raising the trade balance to 12.9 billion Australian dollars, a figure that far exceeded the market's expectations for January. In the coming week, we expect China's trade data for February to be closely watched by Aussie traders, as China is one of the main, if not the main, trading partner for Australia. Now, besides the trade balance, which is in the blue bars here, being the main feature of the release for Aussie traders, the main point of interest may be the imports growth rate, which is depicted in the brown line here. And note the deceleration noted for December 2021. Should the import growth rate actually accelerate, then that would actually imply a higher supply of exports from Australia for the huge manufacturing size sector in China. So we would be advising Aussie traders, okay, keep a lookout for the trade balance, but also focus on the import growth rate. Beyond that, we would also note the release of China's inflation metrics for February on Wednesday, while on Tuesday we get from Australia the consumer sentiment for March and the NMB business conditions and confidence indicators for February. On a monetary level, we cannot pass out on RBA's interest rate decision last Tuesday. The bank, as was widely expected, remained on hold, keeping the cash rate target at 0.10%. In RBA Governor Lowe's accompanying statement, the bank stated that there are uncertainties about how persistent the pickup in inflation will be given the recent developments in global energy markets and ongoing supply side problems, unquote. The statement practically highlights the possibility of an acceleration of the inflation rates being temporary or not sustainable, which could be considered as dovish. Why? Because it practically undermines the confidence of the RBA. We note the planned speech of RBA Governor Philip Lowe on Wednesday and intend to monitor it for any further clues regarding RBA's intentions. Moving now to the Canadian dollar, and this would be USD CADs for our chart in a sideways movement. Despite breaking the 1.2660, we still maintain this support line as the main body of action over the past month or so has seen it providing considerable support multiple times. So it's a level to keep an eye out for. To the upside, the upper level of the sideways motion would be the 1.2785, despite the break here. Nevertheless, further higher, we tend to highlight also the 1.2855 and even higher the 1.2945. To the downside, besides the 1.2660, we would also note the 1.2570. Note the support provided here and the resistance here, practically underscoring the importance of the level, while even lower an ultimate target for the bears would be the 1.2455, which provided substantial support around the 21st of January and reversed the downward motion of the pair. Once again, sideways motion expected, maybe some slight bullish tendencies being represented here given the upward motion here, but still the RSI indicator is running along the reading of 50 with a slight inclination to the upward. Moving to the fundamentals of the CAD, it should be noted more or less that the CAD seems to be slightly in the greens against the USD for a second week in a row. Maybe also supported by the rise in oil prices. It should be noted that the threat of a tight oil market due to the disruption of oil supply because of the war in Ukraine supported oil prices. It was characteristic how the US oil market reported drawdown in the weekly stock figures by both AP and EIA, which took markets by surprise. Even the announcement on Tuesday of an agreement for a coordinated deployment of 60 million barrels by the International Energy Agency's countries was not able to put a lid on oil's prices, allowing for WTI to peak at almost $115 per barrel on Thursday, thus reaching a 14-year high. On the other hand, we must note a wide downward correction in oil prices occurred in the American session on Thursday, which underscored the volatility reflected by the uncertainty in the oil market. Now, negotiations between Iran and the US to reach a new nuclear deal seem to near their completion, and a positive outcome is on the horizon, yet is still highly uncertain. Even should the two parties reach an agreement, and Iran is to re-enter as a major oil supplier the international markets, it may not be able to fill the gap created by a possible lack of Russian oil supplies. Please note that US lawmakers are about to introduce a ban on the imports of Russian energy products. And on the monetary front, we would also like to mention BOC's interest rate decision. that was last Wednesday, the bank, as was widely expected, hiked rates by 25 basis points. And its accompanying statement, BOC sounded confident and determined to curb inflationary pressures in the Canadian economy and expressed their willingness to hike rates further towards that end. Now, it should be noted that BOC Governor Tiff McClellan verified the bank's hawkish intentions in his speech on Thursday. As for financial releases, we note the release of Canada's trade data for January on Tuesday, and we highlight the release of February's employment data on Friday. Now, you can see the relevant chart on your screens right now, and you can see the unfavorable data which was released on last month for January. Practically, we note the rise of the unemployment rate, which is depicted in the green line, while at the same time the employment change figure fell deeply into the negatives. It's only comparable to April 21's reading and January's 21's reading. So hopefully there will be a correction to the upside, entering once again positive territory for the employment change figure, and that would imply or could push the unemployment rate once again to the downside. Such readings could provide some support for the CAD, actually some substantial support, as it would imply that the Canadian employment market has started to tighten once again. Now, before we leave you, and as a general comment, definitely the war in Ukraine is the main issue. It continues to rage, and the humanitarian crisis is ongoing and could magnify in the coming days. Military operations are ongoing, could intensify the market's worries. Also, Russians seem to be fixed on capturing Kiev, and should Russian troops actually enter the Ukrainian capital, casualties could rise to very high levels, especially among civilians. On the other hand, the Russian economy is suffering from the sanctions imposed by Western powers. Up until now, Russians were on the defensive, as they tried to ease the blow on their own economy. Yet, the possibility of retaliatory sanctions by Russia cannot be excluded. The Russian central bank note has ordered a bundle of measures to prevent the bunker run, from more than doubling the key interest rate to 20%, as well as an emergency move to freezing local equity trading since Friday. Russia has also temporarily at least banned foreigners from divesting Russian assets and ordered exporters to sell 80% of their foreign currency earnings. In the FX market, it's expected to be a week ahead with a lighter calendar, allowing somewhat for fundamentals to increase their influence over the market. The US dollar is expected to maintain the initiative over other currencies. Yet still, at certain moments during the week, other currencies may steal the spotlight from the greenback, thus creating diverse trading opportunities. So be on your guard. From all of us here at IronFX, best wishes for solid trading. Thank you.